A very good morning to you, and a perfect time to get your views. Record high for the indices. We've seen a pickup, an all-round good mood in terms of the foreign money that's been flowing in, that's been supporting this rally. What's your sense on whether or not this is sustainable? I mean, it's coming too fast too soon.
I agree with that conclusion, that it's possibly too fast too soon, and as a consequence, in the near term, you could see the market taking a breather. Now, having said that, if you extend the investment time horizon slightly to a medium term or a longer term, I think Indian equities still make sense, and that is why in late March, we upgraded India to an overweight. We earlier had a neutral for about 9 months on that market. And we also upgraded our Sensex target to 42,000 from 40,000 previously. So we are unequivocally bullish on the Indian market over the medium term. The short term may look a bit questionable on account of this very sharp rally that we have seen.
Manishi, good morning. Neeraj here. Are clients happy to put in money into a market like India trading at 18, 19 times? We know the whole of March was arguably marked by ETF money coming into India. Are India dedicated funds or long-only funds who might be large clients of yours putting in big money to work in India, on your advice?
I think even actively managed money has flown into India this year. You know, if you look at last 3 to 4 months, and this is not a phenomenon specific to India only, but all across Asia, we have seen actively managed money come back. And I think this is partly a consequence of the global central banks taking a much more benign view of monetary policy. We believe that the Fed is not going to tighten anytime soon for the whole of 2019 and 20. They would stay put. And, this loose monetary policy, a benign monetary policy, is now a phenomenon that's characterizing most of the global central banks. And as a consequence, I think this flow into emerging market always gets aided. It always gets a tailwind during such scenarios, and this particular episode has been no exception. So yes, I mean, in addition to the ETF flows that you talked about, we have seen actively managed money also come back into India, and we think that in the medium term, that trend is likely to continue.
What drives this optimism higher? I mean, one is the Sensex nudging 42,000 or whatever number it would be. But let's assume that for the rest of the year, there is optimism in the market. Would it be led by banks and specific large caps? Because that would only take the index higher, but not the broader markets higher. Or would you believe that after a bit of a fervor in banks and Reliance and a few others, you would have the mid-caps participating, Manishi?
Well, mid-caps have already participated this year over the last 1 quarter, and we think that the performance of mid-caps and small-caps are likely to continue into 2019. Partly because, because of the sharp underperformance in 2018, they had been appearing a little more attractive as far as valuations are concerned. Second, whenever we have a revival of actively managed money, as opposed to purely ETF flows, mid-caps in India tend to outperform because actively managed money is looking for alpha outside the broader indices. So I think these are the two main drivers at this point of time. Having said that, I wouldn't like to paint the entire mid-cap universe with the same broad brush. We think that there are pockets where, the mid-cap companies with stronger growth opportunities, better corporate governance and corporate disclosures, those are the companies that would tend to win. There are quite a few of them in the financial space. There are a few of them in the engineering auto component space. A few of them in the healthcare space as well. So there's a pretty wide canvas for the investor to choose from. If I look at the broader market or the large cap frontline sectors, our preference at this point lies for the financials, particularly the private sector banks, both retail lenders and corporate lenders. Also for consumer discretionaries and a few small pockets of industrials and IT services, even though we have reduced the focus on IT services considerably from where we were in 2018.
Manishi, I heard you speak about autos. I mean, the recent month has been particularly good for most of the beaten down counters within the auto pocket, and particularly the two-wheelers and the passenger vehicle space. Do you feel that there has been a material change? Because on ground nothing has changed in terms of whether it be inventory levels lying with dealers, whether it be slow offtake in terms of volumes. So keeping that in mind, the recent rally, was it warranted and can it stick?
The recent rally in autos is a bit surprising because I think on the ground the consumption sentiment, the demand scenario has not changed all that much. And we have seen a reflection of that depressed demand sentiment in the kind of production cuts that many of the large auto manufacturers have taken in India. We must also keep in mind that in the near term, we could have some cost increases as a consequence of the newly imposed safety norms and also the enhanced emission norms that are likely to kick in over the next few months. So in the near term, the auto sector might underperform or at best perform in line with the market. Now, having said this, if an investor has, let's say, a 10 to 12 month time horizon, or maybe longer than that, maybe a 12 to 24 month time horizon, there are good quality auto companies which deserve the investor's attention. I would particularly point to those companies which have a commanding market share or a great distribution reach, or the kind of companies which have niche product segments which are growing rapidly.
So in a model portfolio, what is the one that you would assign the largest weightage to? You spoke about financials being your top preference, but to start creating a model portfolio, and where would you distribute your weightages?
Okay. Well, I can't talk about specific stocks, but I would point out that the biggest portion of our weight in India, as far as the Asian model portfolio is concerned, is currently concentrated in financials. And as I said, private banks, both corporate lenders and the retail lenders. And this has actually been a change in our stance. Earlier, I mean, even about a couple of months ago, we were focusing entirely on the retail lending private sector banks, but now we have diversified a bit into the corporate lending private sector banks as well. So financials as a sector is the largest weight. Apart from that, we have a few consumer discretionaries. We have one or two auto names as well, though the outlook there is purely that of a revival in the second half of this year, not immediately. And we have a few names in the IT services, in oil and gas, and industrials. So I think that's pretty much the composition of the India portion of the Asia ex-Japan model portfolio.
You spoke about oil and gas, and one stock that's active, and probably not on the stock, but Reliance Industries is in focus with the interest suddenly coming in from Saudi's Aramco. I mean, what's your take on this?
Right. Well, in general, as far as the sector is concerned, it is obviously a positive, because whenever we see investor interest, not just from the secondary market, but also from primary investors in capacity, that basically indicates a positive outlook for the sector as far as the long term is concerned. Yeah. And, when large players in the sector get interested, when they evince interest over the longer term, that obviously tends to sort of inflate the sentiments as well, and that percolates down to the portfolio investors, to the secondary market investors. So I think there's an overall positive development for the sector as a whole.
Okay. Let's talk a little bit more, and just one last viewpoint from you before we wrap up this conversation is your own expectations and whether or not how closely you're tracking elections and the bearing that it could have in the market sentiment.
Right. Now, election outcomes are almost impossible to predict in India. We have seen historically. And I think election outcomes, they tend to have a short-term impact on the market. In our last report, we analyzed this at length, and we pointed out that even in the previous elections, last 4 to 5 episodes, whenever we have an outcome that is positive from the perspective of the equity market, the foreign inflows tend to accelerate in relation to what's coming into the rest of Asia. But that acceleration possibly lasts for about 1 to 2 months post-outcome. From the third month onwards, it tends to revert back to the normal, to the long-term trend that India enjoys in relation to the rest of Asia. So I think in the near term, a positive electoral outcome would clearly drive the markets higher, but it would be just that. It would be, possibly a short-term boost. What we have to be really careful about are the so-called worst-case scenarios, some kind of a mishmash of smaller parties, like we had seen on previous occasions 2 or 3 times, where the market might doubt the longevity of such a government, and the market may also be cautious about competitive populism coming in. So that is what we have to watch out very carefully for. But we attach a relatively small probability to such an adverse scenario.